5 minutes of finance. The topic of this video is, what does an investment bank do? An investment bank has several divisions. Large investment banks normally have 4 divisions, which I will present you in a second. These divisions are the investment banking, since an investment banking is not the same as an investment bank, the securities, investment, and client management division. Firstly, about the investment banking division, which gets called IBD as well. The IBD division is split into several departments again. The ECM department organizes capital increases and initial public offerings, also called IPOs. For example, when a startup is taking public. In the DCM department, the issuing of bonds is organized, and in the M&A department, mergers and acquisitions, for example, the current acquisition of Monsanto by Bayer. Since this is a very complex topic, we have an extra video for you, where we explain investment banking more detailed. Secondly, about the securities department. The securities division consists out of 4 departments: sales, trading, market making, and research. Their work is to a certain extent comparable to that of a real estate agent, since a real estate agent advises his clients what kind of house or apartment is the right one for the client. In banking terminology, this advisory is called sales. A real estate agent also helps buying and selling real estate, so according to investment banking terminology, he trades. A real estate agent also evaluates the price of a house, so he researches the right price. Moreover, there are also real estate agents buying and selling houses and apartments for themselves, so not for a client, so it is comparable to a market making of an investment bank. Now you might wonder, why is he telling me what a real estate agent does? I want to learn something about investment banks. The reason is that an investment bank does the same. They just do it for securities and not for real estate. They advise their clients in the sales department and fulfill their orders in the trading department. In the research department, they evaluate the right price for the securities. And in the market making department, they buy and sell securities from the customer and not from the exchange. The market making is especially for the forex sector important. Forex means foreign exchange. It is where currencies are exchanged like euro versus dollar. The reason why it is important there is that there is no official exchange for currencies, as there is for stocks. The third large division is the investment division. This is the department where the bank is investing own money. Imagine that your grandmother gives you money for Christmas, which you invest to earn even more money. Due to the fact that you receive hardly interest on your saving account, at the moment you decide that you want to invest the money. There are several asset classes where you could invest the money in. If you prefer it rather safe, you could invest in bonds. If you prefer it more speculative, you would invest into stocks. And if you like it even more speculative, you can invest in startups. For example, Goldman Sachs invested in Uber or Mr. Specs. The department investing in startups is also known as venture capital, so risk capital. The reason for that is that investments in startups are very risky, since one does not always identify the next Google, and a lot of startups go bankrupt, and that invested money is lost. Unfortunately, investment banks don't have a grandmother giving them money. However, they have shareholders who gave them money to invest. And in the case a bank wants to invest even more, they can also borrow money. The fourth large division is the client management, where the money of clients get managed. So the client management does not invest money from the bank, but clients' money. The client management consists out of 2 departments, the asset management and the wealth management. In asset management, funds get managed, where clients can invest their money, so all the clients put their money in one big jar and the bank decides where to invest the money, so everybody invested receives the same yield. The wealth management manages clients' money as well. However, the difference is that they manage the money for every client individually. So the client decides how to invest the money. For example, not more than 50% of the money into stocks, etc. And the bank decides how to invest the money according to the client's wishes. The advantage is that the money is invested according to the client's wishes. Howsoever, it is also more expensive than investing in a fund. concluding investment banks cover all sectors of investment, and they have two types of clients: the clients who have a lot of money to invest, and the clients who need a lot of money, where the money can be invested. Many thanks for watching the video. If you want to support, feel free to like the video and to follow our channel. If you are interested in finance, watch our video where we explain investment banking.